I was paying 110,000, right?
Yep.
But I was paying 90,000. Well, the
Okay.
sellers wanted the sellers wanted 110,000, and I wanted to
Okay.
pay 70,000. The
Yep.
buyer seller gap never goes away, regardless of good or bad markets. So to expect it to go away at this point and wait for it to go away, nonsensical. You'll never end
Yeah.
up buying any properties.
On today's show, we have Neal Bawa. Neal is a technologist who is universally known in the real estate circle as the Mad Scientist of Multifamily. Besides being one of the most in-demand speakers in commercial real estate, Neal's a data guru, a process freak, and an outsourcing expert. Neal treats his billion-dollar-plus multifamily portfolio as an ongoing experiment in efficiency and optimization. Today, Neal and I are going to talk about the interest rate environment today, how it has affected multifamily and commercial real estate, and what are some upcoming opportunities that you can take advantage of over the next 2 years. Neal, great to see you again. Welcome to the Next Level Income Show.
Well, thanks for having me back. It's tremendous to be back and having conversations at this very interesting time in commercial real estate.
Yeah, no, look, like you, Neal, I'm a data guy. With my engineering background, I try to let the data drive my decisions and not emotions. I know you're big on that, as we talked about in the intro. And last I saw you and heard you speak out in Salt Lake, we were talking a little bit about, kind of the potential storm that was on the horizon for this year. And we're seeing some of those ripples here as we come up towards the end of the year. So I'd love to kind of have you start off by sharing a little bit about your background as a technologist before we get into kind of where the economy's headed and what we're seeing here in the real estate markets.
Yeah, well, I think that storm is an appropriate metaphor for where we are today. And I started with a different storm. So 2008 is when I started buying real estate. I was introduced to real estate as a technologist. I was running a tech company, 300 plus employees, nothing to do with real estate. And the senior partner in the firm decided that he wanted to build a campus and needed my help. So in 2003, we built a campus, no investors, no debt. It was the company's money. Company was rich. And we built it from scratch. And I realized the massive depreciation benefits of that. I live in California. I have a big fat tech salary, and I was paying huge amounts of tax until all of a sudden I wasn't, because I was a partner in a company that owned real estate. And so that was eye-opening. And so I started gathering money. I was living the lifestyle, and because I didn't have tax sheltering, I was basically spending all the money that I was making and paying a lot in taxes. So it took me a while to gather the money. I was very lucky in that by the time a storm arrived in 2008, I had gathered up money, and I ended up buying dozens of properties as a technologist and using data science and technology to find the right markets. In hindsight, it seems like almost everywhere you bought then would be good, but that's actually not quite true. And so I fell in love with real estate because I found that I could take technology-driven data science and apply it to real estate and improve my returns. So that's how I got in a storm.
Yeah. And that was, like you said, that was a great time to buy real estate. There's a lot of opportunities there. Oh, sorry.
Sure. But while you were doing it at
Yep.
that point, you didn't think that. Nobody thought that. I would tell my family, my data science is showing this is the best time to buy real estate in the last 50 years. And they would kind of look at me like I was a complete idiot. So back then, I didn't feel like it. Hindsight is 2020. Everyone thinks, oh yeah, whatever you bought in 2008, 2009 must have been fantastic. But back then you were terrified with what you were doing. You're using data science to make yourself just be assured that what you were doing wasn't like the stupidity that other people were telling you it was.
Yeah. And it's, there's a lot of returns that are driven by the lack of emotion. I think one of the statistics with respect to financial advisors is they earn their percent fee, their fees that they charge by keeping investors calm by investing in the stock market. The flip side is I love real estate a lot more than the stock market, but real estate's illiquid. So I think one of the challenges that investors have is that they can't sell it, but that also prevents a lot of the volatility with respect to real estate versus what we see in the stock market. And that means that, volatility is lessened. If you can't sell, then, the price isn't down. What do you think?
Maybe some of the stock market investors that value liquidity should be listening to somebody like Warren Buffett. I mean, today Warren has more money sitting on the sidelines, right? And if you think about it, that's illiquidity. You're not invested. You're not getting a return. There's no return on money that's sitting on the sideline. And he has the largest hoard in his company's history, right? Because his belief is that the only right way to make money is to be illiquid a massive majority of the time and then to be liquid or then to make an investment, get a return a smaller percentage of the time. So the truth is that the reason he's considered the greatest investor of all time is he's one of the most patient. And
Yes.
the philosophy of the stock market is designed to drive you completely insane. In fact, I wrote a presentation about this called Everyone's a Speculator, the Profit Paradox. And it's one that I've actually given away to other syndicators because I think investors need to understand that there is no statistical evidence that investing in the stock market on a day or week or monthly basis is better than investing on a yearly or 5-year basis. But there's enormous amount of evidence, Chris, that if you invest on a 1-year or 5-year basis, you do better than the people that are doing it on a short-term basis. And
Yeah.
and
Yeah.
and so I think it's our sense of wanting to do something about every piece of positive or negative
Yeah.
news that drives us emotionally to make terrible decisions. And so I find that since I am subject to these as much as anybody else, I like real estate because it slows me down. So I don't react to one piece of bad news or one bad video that I see on YouTube. I'd
Yeah.
much rather gather data over time before making a decision. And that's why I get higher returns in real estate than I've ever done with the stock market, even though I've invested in the stock market lots of times.
Yeah. Absolutely. Absolutely. So, Neal, when you started back in 2008, did you go straight into commercial or were you buying single family houses? What did you start in back then?
Yeah, so started with single families, then did duplexes, then triplexes, then fourplexes, then sevenplexes, and then jumped from sevenplexes to 235 units. So
Yeah.
it took a
There you go.
while.
Linear, but non-linear.
Yeah, I was pretty careful about it. I
Yeah.
wasn't in a hurry. A lot of
Yeah.
people go into real estate to make a living. Well, then they have to go pretty fast to get to a
Right.
certain level. Again, I had the big fat tech salary, so I was not at all in a hurry.
Yeah. No, I love it. And yeah, I love to say real estate is a get rich slow game. And as you mentioned, we talked a lot about demographic trends and different trends that you can follow and get in. I've followed several of your investments, and we'll share with the audience how they can follow you and some of the educational resources like your upcoming webinar that you have as well. But so you got started in multifamily, Neal. What asset classes have you been invested in real estate since then? And what are you currently focused on right now?
So, multifamily, um, homes to sell, townhomes to build, which are also called build to rent. So it's a different asset class. It's still like multifamily, but people are living in a townhome as opposed to living in an apartment. Student housing, I've done multiple student housing projects, office and flex industrial, and then self-storage. So those are the different asset classes that I've tried out. And I mean, I came to the conclusion that amongst them, the best asset classes were unquestionably multifamily and built to rent. There's That doesn't mean that there aren't better self-storage deals or there aren't single, student housing deals. That's not my intention to say. But what's interesting is if you take a thousand multifamily deals and 1,000 built to rent deals and 1,000 student housing and 1,000 self-storage and 1,000 everything else. So you're looking at it at a very, very high level,
Yeah.
35,000 square foot level. The multifamily 1,000 deals and the built to rent 1,000 deals represent a lower level of risk. Or a higher risk reward, right? So you can look at it
Yep.
that way. As a risk reward, those 1,000 deals were definitely better all of the other asset classes that I've looked at. Now, I haven't looked at hotels yet. I've been told that the risk reward there is highly unusual and it's a very cyclical product. So I'm curious about that. Maybe we'll get to do it one day.
Yeah. No, I love what you just said there. The risk reward. We talk about the Sharpe ratio in my book, and what's interesting is you mentioned some of the statistics in the stock market with respect to how long are you invested? So you're going to be more successful if you have a longer term view. You're also going to have higher returns if your volatility is lower. So
Yep.
if overall you average a 10% return and you fluctuate between 5 and 15%, you're going to have a higher return than if you fluctuate between positive 30% and negative, what would that be? Negative 10%, right?
Yep. Yep.
If you're gonna add those together and divide that up. So, and that's variance drag. And I think that's the other thing that you mentioned. We have less volatility in multifamily. I've talked about demographics. I think we've been on a terrific demographic ride or wave, as I talk about it, with millennials. Do you foresee that continuing here into the near future? I know you've talked about build to rent. I would contend that build to rent has really benefited as these millennials have formed households, but maybe they can't afford a house and they've decided to rent a townhome or a home instead.
So the answer is yes, and the honest answer is this. The United States is different from all other rich countries in the world that I know of, in that we've always had a very high, an extremely high ownership rate, right? So if you look at the last 20 years, the rate is somewhere in the low 60s. What that means is about 62 to 64% of Americans live in homes that they own, or families, right?
Yep.
Live in homes that they own. And the rest of them basically rent, right? In some shape or form or the other. So that ratio, and I've read 3 different studies on this. The best one is from the University of California. Every single study says that must go down. That 66, 62% was a point in time before construction costs started going nationwide, before infrastructure costs started going up, before we became extremely NIMBY. All of the things that are basically driving up construction costs and harder to do construction have happened really in the last 15 or 20 years. And as a result, when you look at what the average income is today, right, the median income today compared to the median home price, it's astonishingly out of whack compared to what it was 10 years ago or 20 years ago. It's also astonishingly out of whack compared to what it was the day before COVID. So if you look at the day before COVID, snapshot of median income versus median home price, and take a look at it now, you'll notice a staggering difference from that day, which is really 3.5 years ago, to today. A staggering difference. So one statistics that I saw, which was very interesting, is that today, because of increase in home prices and increase in interest rates in the last 3.5 years, you need to make 88% more in income in the last 3.5 years to own the same home that you would have bought one day before COVID. And I don't know of anybody that got an 88% hike in 3 years. The average American got somewhere between 10 and 16% salary hikes. So as a result, we've ended up in a very sad situation. I feel like this is a crisis that maybe the Republicans and the Democrats need to spend more time talking about. It's a crisis. It's a tragedy that between 6 and 10 million American families, mostly the millennial generation, but also some generations before and after them, are simply priced out of buying a starter home. Simply priced out. And in previous generations, before 2010, these people would have had no trouble buying that starter home and then building wealth for the next 40 or 50 years by sort of moving up, right? They don't have a chance. They never will get there. Today, as we're recording this at the end of 2023, mortgage rates are above 8% for a 30-year fix, above 8%. They were under 4% only 24 months ago. So how do you deal with your interest rate more than doubling? So, you're these between 6 and 10 million families, they have to go live somewhere. And the standard answer is they go live in apartments. But their income levels are pretty high. They're actually fairly high for apartments. So they're looking for in-between solutions. And I believe that the in-between solution is built to rent, which essentially is you're building homes, not amenitized. They don't have pools and gyms and any of those things. But instead of being single-family homes, they're townhomes, and they're fairly small. They're between 1,000 and 1,300 square feet, but they've got a little backyard. They've got a little front yard. They've got some cheap amenities like a playground, right, where kids can play, or a barbecue pit, those kinds of things, or a little dog park. So you've got minimum amenities, but you're trading those amenities because apartments have them. You're trading those amenities for the right to have a home, right?
Yeah.
To an actual home. Of course, it's not your home and you're renting it. But I think what I've found is American families are like, yeah, that's preferable to an apartment. And
Yeah.
so that's why we are building built to rent. Here's the forecast: the 19.6 million uh, units of multifamily in the United States that are being tracked. I think
Yep.
there's probably 4 million more that are much smaller. And then there's a bunch of single family homes that are being rented out. But let's call it 20 million. There's 20
Yep.
million apartments in the United States, apartments. And it is now projected that we will end up with about 10 to 20% of that number over the next 10 years will end up being these kinds of townhomes.
Yeah.
So that's 2 million to 4 million units,
Yeah.
right? And if you look at the total size of the market today, out of those 2 million to 4 million, we've only delivered 44,000
Yeah.
total
Yeah.
in the United States, all time, built to rent, total delivery, 44,000. Now that's going to grow. It unquestionably will grow, but there's a lot of room there. And I'm
Absolutely.
looking to be part of that process. That's why I like built to rent. But otherwise, I like multifamily.
Yeah. No, I love it. And I think it's all a slightly different flavor, like you said, of multifamily. And we have 4 of our properties are either build to rent or have build to rent adjacent to our apartment complexes, which we've actually combined one. It gives those residents the amenities that they have with the apartments with that build to rent. But yeah, I think the statistic is we need about 5 million new housing units, and then we need about 4 million new apartment units on top of it. So 9 million combined. We have to increase that number, around about 20%, maybe even 40% that you mentioned to house all these people. And if you prefer a house instead, then I think that's a fantastic area. And we've seen that. We've seen the build to rent communities outpace the apartments on the whole in terms of rent growth, and occupancy, and those sorts of things. Yeah, they've been fantastic. But you mentioned something else, Neal. You talked about interest rates, and yeah, we have the highest gap that we've seen historically between the cost to buy versus the cost to rent. And I've had this conversation with many young individuals who say, I got to buy a house. I got to buy a house. It's like, well, slow down. It's more expensive to buy a home. Do you want to buy a home? But you don't have to buy a home to create wealth. You could invest it in different ways. But obviously it's forced savings. There's a lot of really positive things, which is why it's correlated with wealth creation in this country. But setting that aside.
Yes, but the past
please.
is not like the future. I mean, I think
Right.
that if you really look at that wealth creation was mostly created when homes were much cheaper, right? So if you have a home that was $150,000 in 1982 and that home today is $750,000, can you apply the same benchmark of wealth creation? What I'm finding, and this isn't true universally, what I'm finding in general, the people that are buying home, they are not in the previous cycle of wealth creation. They're caught in a cycle of debt traps. So their home, unfortunately, has gone from being the biggest asset of their life to being the biggest preventer of their wealth because of this 4x, 5x increase in prices in many markets. Again, not a universal statement, but I think that there are hundreds of markets in the United States where that statement is true.
Yeah. No, I think that's a great point. And I think, if you're listening, that's something that you can take away from this, especially if you're in the early stages of your life building that wealth. There's other things that you can do and not just rely on buying a home. We've talked about interest rates a few times here, Neal, and that's not only sent ripples through the residential markets, but as a lot of listeners that are investors know, it's also sent ripples through the commercial markets. And you talked on stage about this out in Salt Lake, where we saw each other, and you have a webinar which it'll air by the time this episode comes out. But the title, "The Storm is Here: Interest Rates Slam Multifamily and Commercial Real Estate." So let's talk about why interest rates are so impactful with commercial real estate, and then talk about what are some of the assets segments that are really getting hit, and where the opportunities could be for investors that are out there today.
Before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, With no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neal's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content.
Sure. Bottom line is that home prices, multifamily prices are highly, highly sensitive to interest rates and always have been, right? But what we've found is that home prices are less sensitive than multifamily, and multifamily is less sensitive than all other forms of commercial real estate. So one, least sensitive single family homes, because it is the most emotional decision out there. Most people that make a decision to buy a home are not really at it from a internal rate of return or equity multiple perspective. They're just saying, I want to buy a home because I want to live in a home that I own. So it's an emotional decision. So they tend to be less sensitive. And then you've got multifamily,
Great point,
which is quite sensitive. It's heavily sensitive to interest rates, but it's not sensitive as all other forms of commercial real estate. And I'll explain why in just a second. Multifamily, amongst those commercial real estate asset class, is the most privileged. And the moment I say this, I think people will get it. So of all the different commercial real estate classes, whether it's self-storage or retail or hotels, office, there's only one asset class where there are three government agency, quasi-government agencies whose only job it is to make sure that that asset class is liquid. And so for multifamily, those three quasi-government organizations, which have over $100 billion a year to meet their mandate of stability, are Fannie Mae, Freddie Mac, and HUD, right? So Housing Development Authority. All of these three are very heavily tied, and there's their mandate, their reason for existence is make that the multifamily and single family market are liquid, right? And if their liquidity drops, then do something about it, right? So for example, recently FAC introduced a shocking 35-year amortization program. We've seen some of those in the single family market for similar reasons. But now in the multifamily market, they're saying, well, we're going to amortize your debt over 35 years. Like, it's a little crazy, but I'll take it, right? Yeah. Because it's the government's money that's being spent, not mine, not yours. Government's money. The government hands out a very large budget to Freddie Mac and Fannie Mae and said, please spend all this money, because if you don't, then next year we'll give you less. Right?
Yeah,
and
it's wild.
If
it's
there's
wild
one thing
that the government is
exactly, and it's like, oh, you want us to spend this money? Oh, so if you don't spend this money, you'll give us less? Oh, we will find a way to spend it, sir. Don't worry about it. We shall spend every freaking dime by December 31st, right? Yeah. So you have three agencies that do this, and you have none for hotel, for retail, for office, for self-storage. They don't care about that. As far as those are concerned, well, there's private banks out there, private lenders out there, they'll take care of it, and we might lend some money to them, but it's not a mandate thing. If we're having trouble lending money to multifamily, or we have a big bucket, we might, sure, we'll do something about it, but it's not our job to do that. Therefore, you have this trifecta of single family, least sensitive, multifamily, quite sensitive, everything else even more highly sensitive to interest rates. And what we've seen is that the peak of pricing on a cap rate basis, cap rate is a way of measuring multifamily prices, because otherwise different buildings, different sizes, different locations, how do you compare them, right? The cap rate is a very useful way of doing that. Yeah. So
let's pause real quick. So for newer listeners, the cap rate is essentially if you're going to pay $1 per dollar, how much are you going to get in return? So for every dollar you pay, if it was a 5% cap rate, you would get 5 cents for every dollar in price that you pay with no leverage, right?
No leverage. If you didn't use a loan, then you would get basically 5 cents each year on the buck that you just paid. Yeah. Another way of looking at it is in multiples. So if you're basically got a 5% cap rate, then you're basically paying 20 times the property's right? And if you got a 4% cap rate, then you're paying 25 times the property's income. And so the lowest cap rate in that, notice 4%, you were paying more than 5%. The lowest cap rates happened in March 2022. So they happened a little over a year and a half ago. And at that point in time, it was very common to see buildings where the actual going in cap rate was below 4%. So people were paying 25 times income, which is a number, right? Bottom line is those numbers were not sustainable because they assumed ever low interest rates. So they were predicated based on interest rates being historic lows and staying there. So once the Fed started raising rates, and they started raising them in March 2022, note that the cap rate height in the same month that the Fed started raising rates. Now that the Fed has raised rates by about 550 basis points on their side, we're now seeing the opposite end of that process. We are now seeing the highest cap rates that we are likely to see in this cycle, right? And people might say they can go up a little bit further, and they might, because there's distress coming. So you might see I think that if there's no distress, we are absolutely at the peak, the cap rates. So we've gone from the lowest cap rates, highest price, to highest cap rates, lowest price. But the X factor there is distress, because stress can bump you above what is the reasonable highest cap rate or the reasonable lowest cap price. We saw that in 2009 in places like Phoenix and in parts of Florida, where basically home prices just were ridiculous because the cost of building was $250,000 and you could buy a home for $80,000, right?
Yeah.
Which made no sense. That was the distress driving the price down far below what it should be. So distress being the X factor, we have seen a decline in multifamily prices in 19 months of roughly 25%. In the cap rate world, we've gone from roughly 4 cap to 5.5 cap for certain kinds of properties that syndicators like. So these are properties where you can add value, right? So those properties, we've seen them go from 4-ish cap to 5.5. These, in the last few weeks, I've seen numbers higher than 5.5 cap. So it might be that in certain markets in the US, the discounts are now exceeding 25%. But by itself, 25% is a staggering discount, right?
In 2 years,
because,
or less than 2 years. Yeah, it's massive.
In less than 2 years, right?
Half,
because I'm going to make a fundamental statement that every investor, everyone looking to buy this as a general partner should heed. If your belief is, so clearly your belief that prices should be that high based on, 18 months ago, that belief was wrong because prices came down, right? As soon as rates went up. So that belief was highly illogical because it required interest rates to be that low forever, right? Now, if you think that today's price is still too high, right? Then you're making the exact same mistake, because now you're believing that interest rates will stay this high for all times in the future. Which means that you haven't studied any of the last 9 interest raising cycle by the Federal Reserve since World War II. They've raised rates 9 times, and every one of those cycles looks like this: zoop, zoop. None of them looks like zoop and then plateau for the next 5 years. Right?
Yeah, they always overshoot.
None of them. They always overshoot. The Federal Reserve's job, and they don't like saying this because it's not a nice thing to say, is to put the economy into a recession, into a brief recession, so that demand can be killed. Because the only way to kill inflation is to first kill demand and then wait 6 months. That's how demand dies. That's how inflation. You must kill demand. The only way to create negative demand in the United States is to create a recession, because that is the definition of recession. The destruction of demand is the definition of a recession. So, Federal Reserve's job is to destroy demand enough and then wait for 6 months. And when we do that, then they can start dropping rates. The Fed, of all the organizations in the world, the one that wants to keep rates high the least is the Federal Reserve. Because they only exist, these tens of thousands of people that exist at the Federal Reserve, they have mandates, and neither of those two mandates work with high interest rates, right? High interest rates are their weapon to get back to their mandate.
They're reloading their gun, essentially, right?
They're reloading their gun, right?
You
can't get there without basically, over high interest rates. So today, this is my core belief based on studying these cycles since World War II. 9 times I've seen the Fed do this. Is the cap rate today is too high. The cap rate 18 months ago was too low. The If you actually pick the middle point of those two, you're pretty close to where the Federal Reserve wants us to go for asset prices. And it's also pretty close to where their interest rates usually are. So study
so
28
mid to high, like mid fours, mid to high fours. Is that what you're for on the whole?
4.5, 4.75
Yeah.
matches today's market and matches the reality of the world there, rather than 4 or 5.5 caps. So at some point they will retrench. So the total discussion really is when and what does the next year look like? So next year is that X factor with the distress, because next 2024 is the distress year for multifamily. We can talk about that. But that's the X factor. So you could also see an overshoot where you see cap rates even going up further when they shouldn't be, because now interest rates are starting to come down, but the distress can drive them up a little bit further. But let's pass the distress year and let's get past 2025 as the stabilizing year. In 2026, I don't foresee cap rates being any higher than 0.75. So when I buy an asset today that I don't intend to sell until 2027 or 2028, I'm buying it cheaper. I'm getting a discount. And
no, I like that. And I love what you said. I heard you say this in the past year or so, when cap rates were low and interest rates were, or cap rates were higher, interest rates were lower, we were getting paid, or when cap rates were low and interest rates were low. Yeah. And inflation was higher, you're getting paid to borrow, because, if you're borrowing at 4% or 5% or 6%, inflation's 10%, you're essentially getting paid to do that. Real quick, because I want to move on to the distress segment before we have to wrap up here, Neal. Today, and I think, let's see here, where are we? About 4.5% on the 10-year today on the 10-year treasury. We were down in the 1% or even lower range, in the past couple of years. So how do cap rates track within the 10-year? I know we've seen fluctuation, in the whole, we've averaged about, a couple hundred basis points, plus or minus, or around the 10-year, but we've also seen it get really close to the 10-year with respect to cap rates. And we've also seen that gap yawn or widen. Do you look at that, or what have you seen with respect to that trend?
It's a terrible rule of thumb, but I'll say it. With every 100 basis points increase in treasuries, cap rates are likely to move about 50 basis points. So your cap rate's going to go up 50 basis points if your treasuries go up 100 basis points. And so if your treasuries have gone up 300 basis points, which is the truth, right now they've gone up 3%. Then your rates have moved 50, 50, and 50, 150 basis points. So that rule of thumb works in most cases, and it should work in the future as well. Simple reason that the only reason that multifamily prices have moved is not because demand has died. Demand is as high as it ever was, and possibly higher, but simply because people can't get loans of a specific price. As treasuries go up, the amount of money that banks will lend you on that property goes down. Therefore, that drives the price more than anything else.
Yeah. And you just made a really good point. I want to underscore that. So a couple things. One, as cap rates go up, prices go down. They're inversely related. As your interest rate goes up, the amount you have to pay for debt service goes up every month. That means that a bank is going to lend you less, because they're going to look at the cash flow you have. So if you could get 75% loan to value 2 years ago, that might be, say, 50 or 55% today, which means you need more capital, which means your returns are going to come down. I think those are really important things.
And that's really forcing the prices down in a very smooth, I'm seeing smooth reduction in prices. The only thing I want to point out is people are expecting that the gap between buyers and sellers will go down. This is a very foolish idea. I hear about it all the time. It's a nonsensical idea, because there's this feeling that if it's a bad market, the gap buyer and seller expectations should be lower. It's nonsense, because even in 2009, when I was, for a property that cost $250,000 to build, I was paying $110,000, right? But I was paying $90,000. Well, the sellers wanted the sellers wanted $110,000, and I wanted to pay $70,000. The buyer seller gap never goes away, regardless of good or bad markets. So to expect it to go away at this point and wait for it to go away, nonsensical. You'll never end up buying any properties.
Yeah, and I think that's what we have, all this liquidity sitting on the sidelines. As those prices start to come down, buyers jump on these opportunities. So I guess leading up to, what we may see here in the next year or two, what is the source of the distress for those that may not be aware of kind of what's happening, and how will that manifest itself in the market, in your opinion?
Sure. Between 2020 2023, inexperienced syndicators purchased thousands of properties, and they bought those properties with the assumption of interest rates staying extremely low. Many of them either forgot to buy rate caps or bought rate caps that are very high. So what a rate cap does is simply caps your interest rate. So you buy it as
Like
a separate
insurance.
component.
Yeah.
It's like insurance. If the rate goes above that, then you don't have to pay that bit. You get capped at that level. And so many of them have rate caps, but they're set high. And many of them have rate caps and they're fine, but those rate caps are going to expire. So 2024 is the year when it all comes together. There's a large number of these properties that have 2 or 3 year bridge loans. Those loans are ending. There's a large number of other properties that may not have bridge loans ending, but their rate caps are running out, and the current price of those rate caps is 3, 4, or 5x what it was before.
Yeah.
There's also properties where we had underwritten for very, very dramatic rent growth to match the rent growth that we saw in late 2021 and early 2022. Well, that dramatic rate growth didn't happen because across the United States for the last 12 months, rent growth was zero. So it was zero for the US, and certain markets up, certain markets down, but zero overall. And so that growth hasn't happened. The value of the properties has gone down. The banks are basically saying, we won't even give you more money to do your rehab because the value of your property is down. We don't want to put more money into it. You put more equity in. So what's happening is we have roughly 3,000 properties in the United States. That number was 2,500 when I was presenting at the Best Ever conference where you heard me in February. Now that's gone up to 3,000 because interest rates have gone up to, the Fed funds rate went up to 550. I thought they'd stop around 5. So with each of those increases, there's more properties getting added. 3,000 properties that are at a debt service ratio of below 1, which is a fancy way of saying they can't pay their debt, let alone pay anything else. If they just pay for their expenses and then they pay for their debt, there's a shortfall, right? That shortfall means that the property is bleeding on a monthly basis. Yeah. And also, as each month goes by, it's easier to fix the bleed in the first 3 or 4 months by using operating cash. Then you start running out of operating cash. Then you borrow money from one person. Then you run out of that. Then you borrow money from another. And every time you borrow money, now you have an interest to pay on that money. And so the situation starts to snowball over time. Yeah. And 2024 is the year when that snowball finally hits something big and causes chaos. Now, keep in mind that 3,000 properties properties in the US are still a very tiny fraction of the overall multifamily market. So while the word distress is useful, the word contagion is not, because 2008 was a $8 trillion problem, 8,000 billion. Today, it's a $75 billion problem. So less than 1% of the 2008 issue. So the people thinking contagion, you're going down the wrong path. Yeah. People thinking limited distress in a certain markets in the United States, you're on the right path.
Yeah, I like that you said that, because it's you watch the news, and I discourage you from watching the news if you're listening. Like just get rid of it. Get rid of it. You got
messes with your head.
Yeah. Listen.
Watch the news. Chris, you can watch the news and be a speculator. Yeah. Or you can read boring scientific stuff and trade papers and be an.
There you go. We're listening to smart people like you, Neal. So there are going to be opportunities. Those are going to be limited opportunities. I don't think we're going to see a big sale like when you walk into the supermarket and you see a big display stand. I think these opportunities are going to be kind of like the off-market deals that get done on the sidelines. How do you think this is going to manifest, Neal? How do you think these deals are going to manifest, Neal? And how can investors take advantage of these, in your opinion?
Well, first is anything you buy today is 25% off, right? One can argue that, well, it should have been some percentage off anyway because they were too expensive.
I'd say my wife says she saved $25 on the pair of jeans that was $100. Is that the same thing?
almost the same thing, except I would say that if those pair of jeans were $100 before and they were $75, the right price for them to begin with was around $87. So you're saving half of that 25 is real and the other half is fake. Okay. So saying it that way, gives you a sense. So you're really saving 12.5% if you think about it. And you're saving that because of interest rates that are going to go down. I don't know but they're going to go down over the next year or 2 years, and then you would have saved that 12.5%, and it's worth it because think about it. 12.5% doesn't sound like a lot, but it takes you almost 40% of the way through to doubling your money in 5 years. That's how multifamily math works. It's a big deal. What we are going to see is in certain markets, the prices are going to drop by 30 or 35% over the next 12 months. I can speculate on what these markets are, but there's too many factors for me to really give you a strong answer. Phoenix could be such a market that we could see, those prices drop more than 30% from peak, maybe 35% from peak for short amounts of time. The other thing that I think we're going to see is the one we're talking about, which is off-market opportunity, where seller financing may become something that we see. So if you take on seller financing for 2 years or 3 years on a project, now you're taking on less equity. So you're raising less money because the seller is essentially the other part of the equity, and you're able to make deals work that don't work today. And the word seller financing was a 4-letter word a year and a half ago, but today there's so many sellers willing to accept that. Because so I think creative financing is going to lead us out of this distress, but is also going to be the biggest opportunity in the of distress.
Yeah, no, I like that. And we're seeing that in our mobile home parks that we're buying, over the last 5 years. Sellers did not want to, they didn't have to do seller financing. And why would they take 3 or 4% interest rate, when they can just sell it outright and go invest their money? Well, now, they'll seller finance it to us at 6 and 7 or 8%, which is still a good deal for us, given the terms and those sorts of things. So yeah, I like that. And I think, the point I want to underscore that you just made, Neal, is that if you're listening, I agree with you. I don't think a contagion is coming. I think there's going to be opportunities. Look at the long term, work with operators, or look for opportunities to find operators that you can partner with and find these deals that are either off market or be creative. But what worked over the last 5 years probably isn't going to work over the next year or so, in my opinion.
Absolutely. I think we have to be creative. The other option, of course, is loans, which I think is the cleanest option. There's not enough of them, and there's not enough of them that work really well. So work extra hard to find true assumptions, true assumable loans. And I think that is those are incredible options if you can find them, and they're there. We bought 2 properties recently. One of them was assumable, the other one was not. And I think that, frankly, the one that was assumable was a better deal.
Yeah. I love it. Neal, I've enjoyed this conversation. I'm a nerd at heart, going back to my middle school math team, and I'll be continuing to follow you with your webinars and the materials you have out. For those listeners that are just getting to know you today, what's the best way to learn about how to follow you, get your educational material, and all the things that you have between You Grow and Grow Capitus?
We don't sell educational material or programs. We give it away. We have a website. We believe that education should be free. And so this website is multifamilyu.com. So that's multifamily followed by the letter u.com. We hold interesting webinars a year. Some of them are about multifamily. Some are about real estate. Some are about other things like AI or climate change. So we do a dozen webinars a year, one a month. And about 25,000 people that are interested or intrigued about these kinds of discussions join us on those webinars. We're actually going to be doing a series of 4 Distress Watch webinars where we'll get into the distress in multifamily. We didn't talk about other forms of commercial real estate today, so we have webinars on as well. And I think those will be very, very interesting for listeners. You can join at multifamilyU.com. There is no upsell. There's no subscription. There never will be. Join, benefit from the ecosystem, and who knows what we might do together.
Yeah, no, I love it. Neal, we love what you do. Check out multifamilyU.com. I try to track every webinar and watch every webinar that Neal does. And no, you've never tried to sell me anything above that, Neal. So I appreciate what you do. We have a similar philosophy here at nextlevelincome.com. Look forward to staying in touch, my friend. And thank you so much for sharing your knowledge here on the Next Level Income Show.